There you go.
Okay, we're going live.
Oops. What happened to my slides?
Good morning and welcome to the Virgin Islands Small Business Development Center. This is the second webinar in our basic bookkeeping webinar series. You're in for a treat again today because we have back at the screen Miss Carmen Acevedo Adams. And for those of you that were not with us last week, let me give you a brief introduction of Miss Adams after I tell you a little bit about the SBDC. The SBDC is a joint venture arrangement between the U.S. Small Business Administration and the University of the Virgin Islands. And as such, what we do is we provide technical assistance for people that are thinking about starting a business, people that are in business and they need to grow their business, or people that are in business and they want to go out of business. So anywhere along that continuum, the Virgin Islands Small Business Development Center is here to assist you. And one of the wonderful things about our assistance is there's no charge for our counseling services. Your tax dollars are at work, and that's why we can provide that assistance to you. And we have an office in St. Croix, which is located at Estate Peters Rest next to Sprint. And we have an office in St. Thomas located on the second floor of Niski Center. Right now, both of our offices are closed to the public. We are seeing people virtually. So if you need to contact us, please use the information that's posted here in the Zoom meeting. Now, today we're in for a treat, like I said, because Ms. Carmen Acevedo Adams is our presenter. And our topic today is accounting methods. Well, it is, right? It's accounting methods.
Yep.
It's accounting methods. And Ms. Carmen Acevedo Adams has worked as a bookkeeper for over 25 years. Her clients have ranged from restaurant owners, contractors, EDC companies, nonprofits, and homeowners associations. As a full charge bookkeeper, she has worked on accounts receivables, accounts payable, payroll, payroll taxes, monthly, quarterly, and yearly, local and federal tax reports, posting of daily sales, bank reconciliations, and general journal entries. In 2016, Ms. Acevedo Adams started her own business as a full charge bookkeeper. She currently works as an independent business contractor for the VI Small Business Development Center, as well as an English-Spanish, Spanish-English interpreter with local attorneys and other businesses. She loves what she is doing and truly enjoys helping people understand the importance of good record keeping for their financial well-being and for their businesses. Now, in today's webinar, we're going to have a few poll questions, and we have a couple at the end. So at the end of the presentation, please do not run away. Stay around, answer our brief poll questions, because that'll help us to better prepare for the next session. Thank you all very much, and do enjoy the presentation. Ms. Carmen Acevedo Adams, the floor is yours.
Good morning, everyone. One of the things that we wanted to know is how many of you are here for the first time? Mary Jo, I don't know if we can please put that up.
Oh, we can. Oops.
Just to see how much of a review.
Okay.
Quick review, very quick review. We can send you the previous presentation via email. If
okay,
you
the poll is launching now. Oh, wow. This is a neck and neck battle, Miss Adams. It looks like 60% of the people did not attend the previous session. I'm ending the poll now. 60% of the people did not attend the first session.
Okay, so in the first session, we spoke about accounting terminology or bookkeeping terminology. What is accounts receivable? What's accounts payable? What is a balance sheet? What is an income statement? What is revenue? What are expenses? So basic general terminology that is used so that now as we go into more deeply into these areas, you will be able to understand. If you leave your email, if you privately in the chat, privately give your email to Mary Jo Williams, we can then go ahead and send that to you later after the session is over, along with this with the session now, so that you can study up on that, okay? Another thing that we spoke about last week was that I was hoping that this would be something that business owners will be looking into. It's very important for business owners to know what is happening with their books. And therefore, that's why we're giving this as basic bookkeeping. You're not supposed to come out of here knowing everything you should know, but you would have an idea of what should be taking place with your books so that if there are mistakes, you can see those. But more importantly, you would know where your business is at any given time. For that reason, I thought that it was also important based on what some of the comments that we had last time, knowing the difference between a bookkeeper and an accountant. There is a big difference. And somehow many people think that bookkeepers should know everything that an accountant does, but we don't. A bookkeeper, basically, we put things together. We gather information, we post it, and we put it together. Once a year, or if you have an accountant that wants to look at your books, at your financials more often, it can be done more often, but at least once a year, all that information is compiled and given to the accountant, and then the accountant decides, okay, this needs to be labeled differently for your benefit. Maybe this needs to be going here. So and the accountant knows the laws, is very well versed on all the laws that pertain to accounting and to financials as regards IRS. So they are the ones that should be making a decision as to how to basically categorize something. A bookkeeper, we know laws, but we are not that well versed in them. We know the basic laws. Again, what should be an expense? What should be accounts payable? What should be accounts receivable? But we don't determine how that applies to the business in the sense that we're not going to make those decisions for you. If you have questions on to how best to categorize an expense so that it gives you the major benefit at the end of the year, you should take that up with your accountant. Accountants have 6 years of study. Basic bookkeepers don't. We are not required to do that. But we have to know what is considered a payroll expense, what taxes we have to pay for you as a business, what kind of reports we need to make, because those are the things that pertain to us. Okay, so I hope, again, general definition of difference between an accountant and a bookkeeper, but I thought that it was important to let you know that a good bookkeeper should have a pretty good knowledge of all of these other things, but also a good bookkeeper is going to know where our limit of expertise goes and should refer you to your accountant when it's necessary. Okay, so let's hope you have a good bookkeeper. So we're going to talk first about accounting methods. Again, also I wanted to say, if you have any questions, post them in the chat and Mary Jo will bring them up to me as we talk, if it's something that is pertaining to what is being considered right now, okay? If you have any other questions, you can also post them in the chat and we'll take care of those later. So accounting methods is a simple concept that allows you to record sale or purchase of an item, even if you have not received payment. There are two types of accounting methods. You have the accrual and you have the cash. Cash method is recorded when you receive the actual cash. Very simple. We're going to go into that a little bit more in detail later. Accrual method is recorded even if you have not received the cash or paid for that expense. You show it when it happens in your business, but not necessarily when monies have been received. Okay, now we'll discuss the difference between these two. The key difference between cash and accrual accounting lies in when your company, I don't know where that came from, when your company recognizes revenue and expenses. Most small businesses can choose either method. However, once a business meets certain criteria, it no longer has a choice. It must use the accrual method. And that's basically once you start making over $5 million a year, you are, by IRS standards, mandated to use the accrual method, which is, let's hope that all of you reach that threshold. In cash accounting, what matters is when money changes hands. When you receive payment for something, you record it as revenue. When you spend money, you record it as an expense. In accrual accounting, what matters is when money is earned. And again, we're going to talk a little bit more about this as we discuss each of these separately. But and why accrual is better for your business, or why cash would be good for your business, okay? When you earn money, you record it as revenue, even if you haven't been paid yet. And you record an expense at the same time as the revenue associated with that expense, even if you haven't paid the cost yet, or even if you paid it a long time ago. So at the time that the revenue, even if you haven't earned the money, at the time that the money is earned. So what would be a good example of this? We talked about maybe having a contract. Maybe you have a contract with someone, and they signed the contract. The contract says that you're going to be paid X amount of money. Now, they don't pay you right away. They will pay you when that contract is done, when that work, whatever it is that you contracted for. But in accrual accounting, you will put that money that they will pay you into your books already, as though it has been earned, because it's as though it has been received. It has been earned but not received, but you account it. It's already in your books. In cash accounting, that money will not be posted until it's actually received, until you have a check, you've made a deposit, then you count that money. Okay, so let's talk about the accrual method. Is a more accurate picture of your company, and it's going to basically I don't know where this came from. I'm sorry about that. Basically, all financial institutions will request financial statements in the accrual method because they feel that it's a more accurate picture of your business. Now, what is the cash method? You record money once it is received, or once you make a cash deposit at the bank. And by cash, we mean it could be check, but it's money that hasn't already been paid to you. Revenues are recognized when cash is received, and expenses are recognized when they are paid. This method is inferior to the accrual basis of accounting, where revenues are recognized when they are earned and expenses are matched to revenues for the accounting period when they are incurred rather than paid. The cash basis of accounting is usually followed by individuals and small companies, but is not in compliance with accounting matching principle. For a small business owner that is just starting, it's understandable that they want to have the cash basis of accounting. They want to know how much they have on hand. They want to know how much is being spent. And it's okay. It's not, here it calls this inferior, but inferior to an accountant maybe. But to a small business owner, this is what they understand, especially someone that is not very well versed in accounting per se. You understand money in, money out. And that's basically what cash method is. So it's not a wrong way of doing it. However, as your business grows, you want to maybe later transfer to the accrual method, because as it was said, it's going to give you a better understanding of your business. Any questions so far? Okay, so let's talk about the accrual. The accrual method is a method of accounting in which all income and expenses are recognized on the income statement at the time when they're earned and incurred. The accrual method reports revenues on the income statement when they are earned. Remember, we talked about balance sheet, we talked about income statement, which is the same as the profit and loss statement. The balance sheet gives you a snapshot of your business at any given time. And the balance sheet or income statement usually takes a larger period of time. Most times a year, it could be a quarter, it could be monthly, but it will give you an accumulated sense of what has happened in your business, accumulated time. At the time that the revenues are earned, the company will credit a revenue account and will debit the asset account, accounts receivable. We're going to talk about accounts receivable a little bit later. We're also going to talk about accounts payable. Notice here it says when the customer pays 30 days after the revenues were earned, the company will debit cash and will credit accounts receivable. So when you are first posting that entry that the revenues are earned but not received, the company will credit a revenue account, and it will debit assets, the asset account, accounts receivable. When the money's actually received, then it will debit cash and credit accounts receivable. The accrual method of accounting also requires that expenses and losses be reported on the income statement when they occur, even if payment will take place 30 days later. For example, if a company has a $15,000 repair done on December 15th, and if the vendor allows for payment on January 15th, the company will report that repair expense and liability of the $15,000 on December 15th. Now, why is this good? Especially at the end of the year, you want to be able to count as many expenses as possible, because that's going to impact that bottom line. And that bottom line is going to determine what your taxes will be, what your income revenue will be, okay? So you want to look at the legal ways that you can, and that is a legal way, let me put it that way, that you can minimize your gross income to what the net will be. So you wanna, by using the accrual method, then you can post that 15,000 repair and take that credit as an expense. And then on January 15th, you will credit cash, because at that time, the 15,000 will, you credit cash because it's gonna be expensed, and you will debit the liability account, okay? The accrual the cash basis of accounting can be misleading, because, okay, let's take the same scenario. A company has a $15,000 repair job done on December. And you are not in cash, you're not gonna count that until January when you make out that payment of the 15,000. So in December, your company is gonna show like it's $15,000 richer. But in reality, you already entered into that agreement and you said you were gonna pay those 15,000. So from the minute that you enter that agreement, you are 15,000 poor. So the accrual method will give a truer picture of where your company is standing. And that's why it's suggested that it always be used. Again, like I said before, cash is not wrong. especially for smaller businesses, but as you grow, you want to have a clearer picture of where your company is. Are there any questions?
I think you might have answered this question, but it says, would you count the revenue when you send the invoice or when the contract is signed?
You count the revenue when you have a contract, because until that contract is signed, you don't know whether you have that revenue or not. So when you have a contract with someone, or let's say you give a pro forma invoice, they sign it, they say yes, go ahead, you can count that money on the accrual method, because you know that money, whether it's 30, whatever amount of time the job requires, that money will come in. But you need to be sure that that money is coming in. You don't want to count what you don't. That I have dogs. I don't know if you're hearing them. I apologize. That money will not be counted. Now, accrued expenses are basically expenses, costs that your business has incurred but have not paid yet. Tracking your accrued expenses gives you a better picture of your company's financial condition than accounting for expenses only after paying them. Okay, and again, I want to emphasize, financial companies will ask you for, when they ask you for financials, they would rather receive them in the accrual method. Okay, any other questions?
I think you answered that question. How would accrual accounting apply to sending invoices?
To sending invoices? Is that the question?
Yes. How would accrual accounting apply to sending invoices?
When you are invoicing for services or goods under accrual, that money is counted as coming in as accounts receivable. Okay, when it's received, the posting is different. Then you will you debit accounts receivable, you credit accounts receivable, and you debit the expense. Then you credit when it's received. You credit accounts receivable. You debit cash. Does that answer, or am I confusing you more?
Patrick, does that answer your question? You can unmute yourself and respond, please.
Yeah, that answers it. Thank you.
Okay. Most small businesses use cash basis accounting, at least when they start out. Cash accounting is simple and intuitive. It resembles the way people track their own finances, cash in, cash out. Accrual basis accounting is a good fit for businesses that do a lot of sales on credit. So this is where you send your invoice. Credit basically means you haven't received the money immediately. You send out the invoice and you're expecting monies later, okay? Usually credit is, I mean, there can be any kind of ratio for credit, but most businesses would say 15 to 30 days credit. And that's when they count, that's how they will know when the monies will be coming in. Oops, sorry. Accrual basis accounting is a good, further corporations are generally required to use accrual accounting, as are businesses with more than 5 million a year in sales and companies that maintain an inventory. This is quoting directly from Internal Revenue Service. Even if you use cash accounting, potential investors and creditors may want to see financial statements prepared under the accrual method. So again, both methods are okay, but one is better than the other in the sense that it gives a clearer picture of where your business is at any given time. Again, maybe you want to start with the cash accounting because you just started, it's a small business, but you need to keep that in mind, especially if you are not the person that is doing the books, that you consult with your bookkeeper and more importantly with your accountant as to when you need to switch over, okay? So keep that in mind. So let's do quick review questions. What does cash method mean? Is it that you record the money as you receive it? Is it that you record the money as you earn it but do not receive it? That you only accept cash when conducting transactions, or that you do not accept cash when you're conducting transactions? Cash method means that you record the money as you receive it. Okay, simple. When are receipts recorded with the cash method? When the transaction is completed, but the payment is not made. When the payment is received. The fiscal year following when the transaction is completed. The quarter following when the transaction is completed. It's receipts are recording with the cash method when the payment is received. Okay? Again, talking about the cash method. What does accrual method mean? That you record the money as you receive it, that you record the money as you earn it but not receive it, that you only accept cash when conducting transactions, or you do not accept cash when conducting transactions. Of course, is that you record the money as you receive it. So accrual is when you record the money, that you record the money as you earn it. I apologize, but not receive it. Cash is that when you receive it. Accrual, you record the money as you earned it, but did not receive it. I don't know what's causing that. Are you seeing those little scratches on the presentation, Mary Jo?
Yes.
Okay, I don't know what's causing that. I apologize. What statement are income and expenses recognized on? So you have balance sheet, and this was something that we considered on our first time around, and it was briefly considered. We are going to talk more about what these financial reports are by themselves in the next time around. Okay, our next session, which is next Tuesday. Balance sheet, statement of cash flows, income statement, declaration statement. What statement are income and expenses recognized on? Well, the income statement. Okay, so the income statement is also known as the P&L, or profit and loss statement. What is the main difference between the cash method and the accrual method? No difference. The accrual method is only used for large businesses, while the cash method is only used for small businesses. The accrual method is only used for small businesses, while the cash method is only used for large businesses, vice versa. The time at which the receipts are recorded. So, what is the main difference between the cash method and the accrual method? Basically, is the time at which the receipts are recorded. One is when it's actually received, the other one is when it's earned. What anticipation would you have when recording using the accrual method? Receiving the funds at a later date, immediately receiving the funds, not ever collecting the funds, receiving a tax write-off, eventually having to convert the recording to the cash method. So you can anticipate when you are recording using the accrual method that you are going to receive the funds at a later date. Any questions in there so far? So again, keep that in mind. The main difference is the time in which the receipts are recorded, or and when the funds are received. Not when the funds are received. When do you post the funds as received? Okay. Any questions?
Not yet.
Okay. Keeping track of your business. In this section, we're going to discuss the ins and outs of accounts payable. What is accounts payable? What is accounts receivable? What is the journal? What is the general ledger? And cash management. Accounts payable is very, very important because that is the the definition of accounts payable is important to you because it's the money that you're going to receive, that you're paying out. And that is going to determine how the balance of your business is going to go. So regardless of the company size, the mission of accounts payable is to pay only the company's bills and invoices that are legitimate and accurate. What does this mean? This means that before a vendor's invoice is entered into the accounting records and scheduled for payment, the invoice should reflect, must reflect what the company ordered, what the company has received, the proper units of cost, calculations, total terms, etc. So this means that the person that is doing this posting has to look at that invoice carefully, has to know, be knowledgeable of what that invoice is talking about. So if you have your bookkeeper should know, to be able to know that, she should be very knowledgeable on your business. How do you make your money? What is it that you do? How does that cost? What does that cost you? That a bookkeeper should have that background knowledge so that when she sees that invoice, she will be able to say, wait a minute. They said they were going to charge this for this particular service, and they're charging you, look, they're charging you $10 more. Or they said that the service was going to be provided from September 1st to September 30th, but this invoice is showing that they're invoicing you only until September 20th. So a good bookkeeper is going to look at your accounts payable, at those invoices that are coming in, those bills that are coming in for payment, and she should be looking out, she or he should be looking out for your business by carefully reviewing those invoices before posting them, okay? So to safeguard a company's cash or other assets, the accounts payable process should have internal controls. A few reasons for internal controls are to prevent paying a fraudulent invoice. It happens. Prevent paying an inaccurate invoice also happens. Prevent paying a vendor twice. That may happen. A vendor, maybe you have not paid it in 15 days and the vendor is getting antsy. They send you the same invoice again. If the bookkeeper is not careful, she's going to enter that invoice as a new invoice and you may end up paying for that service twice. Now, a lot of companies, especially small companies today, use QuickBooks. One of the good things about QuickBooks is that QuickBooks is going to tell you when you enter an invoice number twice, it's going to tell you, wait a minute, you already have an invoice with that number. So it gives you a prompt for you to go back and take a better look at that invoice. But you should not depend on software telling you that. It's something that should be part of what you naturally do. When you receive an invoice, you check it against what that company has invoiced you for before, and you make sure that it is a valid invoice, okay? And be certain that all vendor invoices are accounted for. Important that you post all your expenses, all your, what your business is important, your revenues, but it's equally important that you account for your expenses, because that's going to be a big determining factor at the end of the year on how well you did or how much money you have to pay out, okay? So keep that in mind. So business owners, last time we talked and we had a lot of business owners that were trying to either do their own bookkeeping or at least have a rounded understanding of bookkeeping. This is something that I would emphasize to you. Make sure you're a bookkeeper, or if you are doing your own bookkeeping, make sure that you pay only what is legitimate and accurate, and that you review those invoices before you post them for payment, okay? You may say, oh, I know Harry and he will never cheat me. But Harry may be not the person who actually wrote the invoice. It might be somebody else who is not aware of maybe all the understandings between you and Harry. So you need to check those invoices for accounts payable, okay? Any questions?
One question.
Mm-hmm.
If you have a one-year contract that started in July, would the entire value of the contract be applied to the current year taxes, or would we break it into two parts?
Why two parts?
It's for the year. The contract started in July, the year ends in December. So the part that would be for services rendered next in 2021.
Okay, so one of the things we spoke about last week was fiscal year versus calendar year. So if you have a calendar year, then your company's finances are expected to be reported at the end of December. So in that case, you would have to do that half of that contract and show what has been received up to then, okay? Or what is expected to be received up to then. If you have a fiscal year, then it would be the total year, and you would report it at the end of your fiscal year, as you would normally do. But when you have a calendar year, the cutoff date for that report is going to be December 31st. So whatever has happened up to that time, that's what you're going to report on. Okay? Answered?
Give us a thumbs up, Patrick, if that answered your question. Go ahead and continue, Carmen.
Okay, so accounts payable is what you are dishing out to others. An interesting point to keep in mind is what is your accounts payable is accounts receivable for another company. So they are going to be just as interested in making sure that what you're paying them is accurate. So they also are going to be reviewing that. Accounts payable is a liability to the creditor, okay? So basically, the person that is giving you that extension of payment is a liability for them. And it will normally have a credit balance. When a vendor invoice is recorded, accounts payable will be credited and another account must be debited. We talked about the double entry accounting. When the accounts payable is paid, accounts payable will be debited and cash will be credited, okay? When a company, in the accrual method, when a company is receiving goods or services on credit, they must report the liability no later than the date they were received, okay? So that under the accrual method, accounting expenses are reported when they are incurred, not when they're paid. So accounts payable, the person who's taking, and some businesses, maybe only one person does accounts payable and another person does accounts receivable. So this person is going to pay very close attention to those invoices that are being received and whether those invoices are correct. Maybe you may have a check and balance. Let's say that the person will send you a list of the things that before they send you the actual invoice, a detailed list of what it was that was sent to you or given to you, to your business, or sold to your business, not given. So then you will be able to, usually an invoice is very concise, but if you have a detailed list of items that were sold to you, you will be able to determine whether that invoice is accurate or not. So that's one way of checking and balance that. But you should pay very close attention to what is in your accounts payable list. And as a business owner, you should also expect your bookkeeper to keep up to date when these bills are due. It would be good to request an accounts payable report every week or every 2 weeks for you to decide, or for whomever the person is that makes that decision to decide what will be paid and what will not be paid. But your bookkeeper should have that running list, and she or he should know to tell you Mr. So-and-so, we have to pay this bill by this date or else you're going to incur late charges. So give you a heads up, okay? So a good bookkeeper should be able to do that as well. Any questions? Okay.
No questions.
Accounts receivable. So what is accounts receivable? If a business makes a sale or renders a service, it has receivables. This means that the business has money to collect or receive for its products or services. This type of record is used to keep track of money which is owed to a business. Such money can come from extending credit to a customer who purchases the business products or services. The best way to keep track of these records is to set up a separate accounts receivable record for each company. Okay, again, we are also talking about, and we're going to talk about this on ledgers, of keeping, this is done on a separate ledger. It used to be done when everything was done by hand. Now, a lot of accounting software will immediately post these entries for you when you make one posting. So if you have the accounts payable, you posted your invoice, and then you're going to pay that invoice. Every other account, every other expense and income account that has to be checked off with either debited or credited, that software is going to do it for you. Before, you had a ledger for this, a ledger for accounts receivable, a ledger for accounts payable, which means accounts payable would have its debit and its credits, accounts receivable would have its debits and its credit. So you would need to do the posting when you were going to pay this, and then how that affected the receivables, you were going to do that posting as well, okay? But again, most of the software today do that for you. It's very important that we know how to label an accounts receivable. Why? The accounts receivable can determine how much you pay gross receipts for, how much gross receipts you pay at the end of the month. So maybe you, accounts receivable is for money for products or services that you have done, but you may have money coming in that you want to put into your bank, but has nothing to do with services or products that you have given. For example, I have a client that has a contract and he provides, let's say he provides AC units to people and he puts them up. He is sort of the intermediary between the company that sells the AC and the customer, but he doesn't make any money in the selling of the AC. He can refer the AC company to the person and say, you know, they make good ACs and I can get it for you and whatever, but the AC you pay separately to that company. However, your client wants to pay you for that money and then you pay the company. That money is, you are not making, if let me say it this way, if you're not making any money in that transaction, if you are merely a go-through person, that should not be reflected in your revenue, and it should not be taken into consideration for your gross receipts. That is not money that you have made, that you are, so how that is posted is very important in how that is going to show at the end, okay? And when you do your report at the end of the month. So keep track, keep in mind, accounts receivable is for monies, for products or services that you have provided. You're being paid for those services, you're being paid for those products, you're being paid for whatever it is your business does. It's not for every single monies that come into your business, because there are other monies. You took a loan, okay? That is posted separately, that is posted differently. Okay, so keep that in mind. And again, I hope I'm not confusing you more remember, this is basic bookkeeping that we're learning, but it's important that you are aware of things that can affect your business if you are thinking of doing the bookkeeping yourself. So that's why always recommend have a good accountant and discuss things, even discuss the bookkeeping method with your accountant, because they will be able, based on your particular business, and this is something that we also discussed the first week, the bookkeeping method is going to be based on your business, what you do. It should be tailored to your business. What expenses am I going to keep track of? What accounts receivable am I going to keep track of? Should be tailored to your business. Okay, so this is very important that your bookkeeping is being done correctly. So you may want to review that with your accountant, and then you can tell with your bookkeeper, okay, this is what I want you to track. This is so it's a chart of accounts. That's the backbone of your record keeping. So that chart of account has to be tailored to your particular business. There are things that a contractor is going to keep track of that a person that has a restaurant is not going to keep track of. It has nothing to do with them. They don't need to keep track of that. So make sure that your bookkeeping is tailored to your particular business, okay? And again, my suggestion is speak to your accountant and let them see what your chart of accounts looks like. Again, a good accountant, once they review that information at the end of the year, if they see that changes are necessary to how it's being kept, they should also speak to the owner or even to the bookkeeper, okay? There should be a good relationship between your accountant and your bookkeeper. It should not be a cat and dog relationship at all. Okay, any questions there?
I have a question.
Mm-hmm.
What percentage of accounts receivable does business owner pay to VI government?
Gross receipts are 5% of over, if you earned under 225,000 a year, you can actually report your your gross receipts on a yearly basis. If you earned over 225,000 a year, you have to report your gross receipts on a monthly basis. There are exemptions, a $9,000 exemption that is given to some businesses. And you can go to the BIR website and you can get that information there. Okay, and this is something I was going to refer you to at the end of the program, irs.gov, and I think it's bir.gov. Should be one of your favorites in your in your search engines, because they have a lot of information there that can be helpful. Again, your bookkeeper should keep up to date. Like, for example, not too long ago, the Virgin Islands Bureau of Internal Revenue was giving a amnesty for gross receipts paid late from certain years to certain years. And if you were late in paying those, they would forgive, I think, the penalty and the interest. So that's an excellent thing for someone that is, really tight on money, and they will always give you the ability to pay in installments. So as a bookkeeper should try to keep abreast, always be checking those websites, keep abreast of what's happening with the laws, with local laws versus federal laws. There are changes that are coming. I mentioned this before also last week. There are changes that are coming with the payroll taxes that have been suggested. I don't know, I don't believe it's law still, but that would also affect a lot how taxes are paid when, but it also can have implications for the employees, not just for the employer. So all of those things you want to keep abreast of. Call BIBIR whenever you have a question. They're always ready to give you an answer. It's always good to have a good relationship with them also, so that you can feel free to call them when it's necessary, okay? So you have to, it's important to keep abreast in these things, okay? Anything else? Any other question?
Nothing, right? Oh, please repeat the post. Okay, we'll put the post for the VIIRB in the chat.
And IRS is basically www.irs.gov.
Yeah, but IRB is different.
I always think of BIR, but that's not how they're shown in the website. I think it's BIR.gov, something like that. So I don't want to give you the wrong. I'll let Mary Jo do that. But there, all of the forms that you need to use for reporting, the gross receipts, the monthly reports, for example, for payroll, if you have to pay hotel tax, if you have to pay excise tax, if you have to pay, if you have to do the quarterly reports that are mandated by law to make for payroll, all of those forms are there and they're downloadable so that you can use them. Okay.
Okay. What was the gross receipts range just for monthly and yearly payments?
225,000 the last time I checked. If you make under that, then you can do a yearly report, and there's a yearly form for that. Now, keep in mind, however, and this is the tricky part. Let's say last year you made under 225,000, so you did a yearly report, and this year you don't worry about reporting January, February, March, April, but then as of May, business picks up and you start making more, and you figure that by the end of the year you're going to make over the $225,000 range. Then you have to go back and report. You're going to have to start reporting more monthly. Not only that, you have to go back and report those months you have not reported as yet. Okay, very important. So if at any given time in the year you think you are going over that threshold, you have to go back and report those months. And you can maybe put a little note saying, you know, threshold reached this month, and that's why the reports are supposedly late, but they're not, because up to that point you were not really required to report it. So keep that in mind, please. One of the many things.
Mm-hmm.
Any other question?
No, I think that's it for right now.
Okay. So let's talk about the journal. So the journal is a way to keep track of all inputted information or data with regards to a business to allow for the books to be properly balanced. So it's basically a balancing act. When dealing with journals, you will also be dealing with debits and credits. You cannot use one without the other. For your balance sheet, it's called a balance sheet because it's supposed to balance. We talked about that last week. The assets, the total of that, and later your expenses minus, I can't remember what it was, should equal, okay? Should be the same total. That's why it's called a balance sheet. So anytime you have a credit, you should also have a debit. Anytime an account is credited, another account has to be debited, okay? And vice versa. Anytime an account is credited, there's something else that has to be debited. So there should always be two. It's a double entry system. So there should always be two entries done. Again, software today makes it easy for us, but still, like for example, when you write a check, you're writing a check out, and at the bottom, you have to explain what expense account it's being credited, okay? And the top, you have to make sure that the correct banking account is being debited. So these are things to look out for that a bookkeeper, when they're doing and putting in the wrong account number, is gonna mess up your reconciliation at the end of the month, because you're gonna show a check written from this account number. When your statement comes, it's nowhere there. The next statement comes, it's nowhere there. So then you go and you see the other bank statement from the other account, and you see it there, but it shouldn't have been. Especially when you have accounts that are specifically set up to handle. Let's say you open an account. Okay, give you an example. Right now, a lot of businesses were encouraged to apply for the PPP program, right? Payroll Protection Program. And the bank that you got it from encouraged you to open an account with them for that. And so you don't want to make checks out from that account for things that will not be approved and later forgiven under the PPP program. So that is just an example of why it's so important that you always double check everything you do, that you understand what is being debited and you understand what is being credited, okay? So you can use one journal for all transactions or several journals for similar or like transactions. Again, software today does that for you. A simple example is when we keep track of our checkbooks by entering both our purchases, which would be considered debits, and our deposits, which would be considered our credits or money received. That is known as balancing your checkbook. Keeping a journal is basically the same concept. Remember, always try to be as accurate as possible, or you will throw everything off balance. And that's the best way. A reconciliation of your accounts, of your bank accounts, should be done on a monthly basis. You would be surprised how many mistakes are picked up when you're reconciling your bank accounts. Okay, so it's important that that takes place as early as you receive that statement. If you are able to get your statements online, you can get them before the 15th, and you can have your bookkeeper do the reconciliation as early as possible. Oops, sorry, I wanted to go down here. An accounting journal is the official book of a business in which the transactions are recorded in a chronological order. Some refer to the journal as the book of original entry, since the entries are first recorded in a journal. And you can have a journal for your accounts receivable, a journal for accounts payable, a journal for any other expense that you may have. With manual systems, there are likely to be a sales journal, purchase journal, cash receipts journal, cash disbursements journal, and the general journal. With computerized accounting systems, it is likely that the general journal will be used sparingly. The software is likely to record the other transactions automatically as invoices are entered, checks are prepared, receipts are processed, etc. So let me talk a little bit about that. Because there's always a wrong and a right way to do things. Even though, like, let's use again QuickBooks. QuickBooks is a very popular, very simple, and user-friendly software for accounting or bookkeeping. QuickBooks is only as good as what you put into it. QuickBooks is only going to tell you what you have told it. Why do I say this? You have to know how, as I mentioned before, when you're expensing something out, when you're writing a check and you're going to expense that amount that you're writing, you have to know where to put that expense. Is this expense related to a job? Then you want to make sure that that job is being checked off. Okay, so that when you're doing that report at the end of the month, or however often you want to do that report, you know how much you have expensed out under this particular job, and you have a better idea how profitable it is going so far, okay? You wanna know, did I charge enough for this job? If at the bottom line, when you put in what you were paid, and then you put in everything you paid out, you know, was it profitable? But you would only know that if when you are putting in your expenses, when you're recording your expenses, is being recorded to the right place. So again, you have all of these reports that you can get out of QuickBooks, but the reports are only going to show what you have put into it. Okay, oops, I'm sorry about that. It's telling me that it's time to start wrapping up. So you want to make sure that, again, if you're a business owner and you're not the one doing the books, you want to request reports every so often so that you can look at them. Request a balance sheet, request a P&L from your bookkeeper, and that is going to give you the accounts that are being targeted by the income and by the expense, and you will have a better idea how accurate these are being done. And then you can say, Mira, maybe you put this under the wrong, this needed to be over here because it's for this job, not that other job. And it helps your bookkeeper. Your bookkeeper can't read your mind. You're the one that is doing your business. You know everything that is going on in your business. You have to verbalize it and share it with your bookkeeper so that they in turn can post things correctly. Okay, so the journal, again, computerized or software does a lot of this for you, but only if you enter it in the right place. Only if you enter the first entry in the right place. So the general ledger is, there's different types, okay, of general ledgers. You have balance sheet accounts that are assets and liabilities, stockholders' equity. Then you have income statement accounts that are revenues, expenses, gains, losses. Usually it's a T-shaped on paper, okay? But basically you will have assets and liabilities, gains and losses, revenue and expenses, and it will give you the bottom line. For example, balance sheet accounts, cash, accounts receivable, prepaid expenses, equipment, accounts payable, notes payable, retained earnings, and more. These are called permanent accounts. A few examples of the income statement accounts are sales revenues, service revenues, investment income, wages expense, rent expense, utility expense, advertising expense, if you have that, insurance, depreciation expense, interest expense, gains on sale of assets, loss from a lawsuit, and many more. The accounts in the income statement are referred often as temporary accounts because the account balances are closed at the end of the accounting year. Okay, so the income statement accounts will begin each accounting year, should begin each accounting year with a 0. Again, this is, now, a bookkeeper does not close books. An accountant closes books. Okay, so once the bookkeeper gives all of that information to the accountant, then the accountant will do everything that he has to do. And if he has to, you know, reshape it a little bit, he will reshape it. Hopefully he will then let the bookkeeper know how it has been reshaped so that then it can continue in that same way for the following year. So there should be a good communication between the accountant and the bookkeeper. So the general ledger is usually the main record of accounting that a business uses, okay? And again, with computerized bookkeeping, it's very simple. Any questions? Nope. Okay, let's go. Cash management. Cash management is the process of collecting, managing, and investing cash. It can ensure business financial stability by avoiding insolvency. In a business, the term cash does not only refer to money or the amount of money at the end of the year. Cash and the management of cash can also be used to refer managing anything that can be made liquid, like certificate of deposits by selling them, short-term investments, and anything that can be used as a cash equivalent. The art of cash management in a business is very important because it is essential in keeping a business operating properly. If there is a mismanagement of cash, it may result in a big loss of revenue for any business. Proper cash management will help make sure a business does not become insolvent. Anytime a business cannot pay any of its bills due to a lack of cash, that means it has become insolvent. Insolvency is the main reason for a company to go bankrupt. And we don't wish that on any of you, okay? So cash management is important. Again, keep in mind, it's not the bookkeeper's job to do your cash management. That is your job or whoever else you may have hired to do that. Bookkeeper's job is to keep track of every transaction that goes on in that business. So it's up to you to make sure that cash management is being done for your business. So what you want to do, how your bookkeeper can help you, if that bookkeeper is up to date in her recording or his recording, they can give you these balance sheet reports. They can give you the accounts payable reports on a given notice, especially when you have software that is, that is doing all of that for you. In QuickBooks, let me have an accounts payable report. You just hit the reports, accounts payable, and it should tell you in moments what you have, what money you owe. At the same time, they can give you an accounts receivable. What money is out there on the road? What money is out there? Why? And so you have $10,000 that you need to be paid by the end of the month, and you have $20,000 that is owed to you out in the streets. So those reports are going to help you to say, okay, we need to, turn the screws a little bit on these people that owe me money because I need to pay this much. Because if what is going out is less or not equivalent or more than what is coming in, then you're going to have a problem, and you don't want that. And that's where reports, knowing where your business is at any given time is key. And a good bookkeeper should be able to help you by giving you the reports on what is going on in the business and providing that for you so you can make the decisions. Keep that in mind. You make the decisions. It's your business. So the bookkeeper can tell you, yes, this customer pays on time, or no, that customer tends to pay a little late, or that tenant, we're having problems. That kind of thing it's just basic information that should help you to make decisions, but you are the one that makes the decision as a business owner. Okay? Questions?
No questions. Somebody said they could not hear.
Can you hear me now?
I can hear you. Is there another affordable software small businesses can use assistance, I guess, other than QuickBooks?
There are many. I would encourage you to go on the internet and check on that, because there are many. QuickBooks is just user-friendly, and it's cheaper than most. But you don't have these. A good spreadsheet can help you, and a spreadsheet would become a ledger. But yes, there are many software out there. And again, also with QuickBooks, speaking of QuickBooks has different programs, depending on your business. So they have some that are industry specific, like they have a program for nonprofits. They have a program for contractors. They have a program for retailers. So these programs are already adapted for your specific business use. And that means that their chart of accounts, how expenses and how income is labeled, is already set up there, but you can tweak it always, you can change it. But and they have a very simple, basic bookkeeping that you can then tweak and modify to fit your business. Okay. So you want also, when you're purchasing a software, you want to make sure that it would fit your particular business industry. Okay. But I mentioned QuickBooks just because it's so easily available, it's so much used, but there are many others. There are others out there. You just have to do a little window shopping on that on the internet. Any other question?
Nope.
Okay. So let's do some reviews. Let's do some review questions. What does accounts payable track? It tracks debts owned by a business to a creditor, debts owed to a business, employee payroll obligations, the types of bank accounts owned by a company. So it tracks debts owed by a business to a creditor. It's what you're paying out, okay? You are paying out. To them, it's going to be accounts receivable. To you, it's accounts payable. So it's money that you have to dish out. Why is it important for the company to keep track of accounts payable? It's not necessary for the company to keep track of accounts payable. The creditor will do so. So the company knows its financial standing at any given time. If they don't, they can be fined by IRS. If they don't, they can be fined by the state. You want to know, you want to keep track of your accounts payable so you know your financial standing at any given time. You want to know how much is coming in, but you also want to know how much needs to go out. What does accounts receivable track? Debts owed by a business to a creditor, debts owed to a business, employee payroll obligations, the types of bank accounts owned by a company. So, what does accounts receivable track? Debts owed to a business. Accounts receivable is how much money do you have out there that is owed to you? Very important account to keep up to date as well. So accounts receivable and accounts payable, I would even say two main accounts that you definitely always want to have up to date. You always want to know how much you're owed. You always also want to know how much you owe, okay? Because that's going to determine the health of your business at any given time. Why is it important for the company to keep track of accounts receivable? It's not necessary for the company to keep track of accounts receivable. So the company knows who owes it money and when that money comes in. If they don't, they can be fined by IRS. If they don't, they can be fined by the state. So of course, you want to know, you want to keep track of your accounts receivable so you know who owes you money and when that money is supposed to come in. Again, when that money is supposed to come in, because you have in the contract that if they don't pay you in 30 days after the 30, once that day after the 30th comes in, you can start charging 10% interest, or you can charge, say $1 per day for late fee. So that's more money that you have coming in, and you want to make sure that that money is accounted for. Okay, so you want to keep track of not only how much you're owed, but when is that money owed to you. The journal includes what information? Debits only, credits only, debits and credits, none of the above. The journal includes debits and credits, okay? So for every positive credit, there's a negative, a debit, but it's not always seen as negative and positive, because then it can be switched, and that's another issue altogether, and we'll go later on down, we'll talk about that. You must always use a separate journal for each transaction. Always true, true only if you are a large business, true only if you are a small business, false. You must always use a separate journal for each transaction. Yes. Oh, false. Oh my goodness. I'm giving you wrong information. No, because again, the one journal is going to have the positive and the negative. So that's in there, not each transaction. Although you can use separate journals for each transaction, it's not mandatory. Okay. The general ledger is used in what type of accounting? Double entry, simplistic, cash, and accrual. The double entry, okay? The general ledger is going to have your credits and your debits, and it's going to, so there's always a double entry. The general ledger is considered what type of record? The general ledger is considered temporary, permanent, used only by large businesses, used only by small businesses. It's a permanent record, okay? Now, the use only by large or by small businesses is only brought out because we talked about cash and accrual and how as a small business, you might start as with cash, okay? Because it's easier, but as your business grows, you wanna have a more accurate and more clear picture, and you may want to go to the accrual method, okay? So that's why we're talking about large and small businesses, but record keeping is for any business. Cash management refers to doing what with cash? Collecting only, managing only, investing only, all of the above, okay? So cash management includes your collecting, your investing, your managing. Cash management helps businesses avoid what? Insolvency, being audited, losing any customer and clients, losing employees. It can help you to avoid insolvency / bankruptcy, okay? So again, important that it's important that as a business owner, you know what is happening in your business. And I am sorry if I'm emphasizing this a lot, but it's that as a bookkeeper, I have seen so much of business owners simply giving a bunch of papers to the bookkeeper. Here, you take care of that, and they forget about it. True, that's the job of the bookkeeper, but it's your job to know what's happening, what those papers mean. And when someone tells me, oh, I have it in my head, I want to wring them, wring their neck, because you cannot have everything in your head. And you cannot see just, I mean, you have to be exceptional to be able to do that. You need to have proper bookkeeping of everything that is going on in your business for you to be able to have a good, clear picture, and then to make informed business decisions, cash management decisions. So besides giving the whole bunch of papers to your bookkeeper, at any given time, you want to ask that bookkeeper, let me have this report, let me have my accounts payable, let me have my accounts receivable, give me a balance sheet as of today, let me see the income statement for last year, let's do an income statement now. Okay, so these are things that you're going to need, and by seeing those, you will also be able to tell whether these things are being posted correctly or not. So cash management is on you. So what will we consider next week? We're going to talk about understanding the balance sheet, okay, the accounting equation, double entry accounting, which we have mentioned. We are also going to talk about other financial statements like the income statement or profit and loss statement, the cash flow statement, capital statement, and budget versus actual. All these are things that if your books are up to date, you should be able to get at any given time. Mary Jo? Mary Jo? No?
Sorry, I'm here. Okay, so we have poll questions. Let's see. I'm going to ask a poll question. We asked already, are you in business? We're going to ask, was the level of the presentation, was it too easy, just right, or too difficult? And if you guys will take a few seconds to do that. And I'm mentioning the questions for the people that are on Facebook, and hopefully they'll want to join us in Zoom next time so they can have a chance to answer the questions. And we'll give you 4 more seconds. And the poll is closing now. And 94% of the people say the presentation was at a level that was just right. Yay.
Yes.
That's a good one.
Thank you for that.
All righty. Next poll question. Let's see. Oops. We asked if you attended previous presentations already. Where are you guys located? Are you on St. Croix, St. John, St. Thomas, Water Island, Puerto Rico, or other? And that poll will end in 4 seconds. 3, 2, 1, 0. And 46% of the people are in St. Croix. That's the exact opposite of last week. Majority were from St. Thomas. We have 5% from St. John, 43% from St. Thomas, 2% from Puerto Rico, and 4% other. Very good. All right. And the next question is, oops, where's my next question?
Likely to complete the series?
Are you likely to complete the series? Oh, looks like I didn't put that question in there. Shucks. Well, you guys, if you're likely to complete the next 4 workshops and the next 3 workshops in this series, please indicate in the chat.
So I want to emphasize, keep in mind, this is basic bookkeeping. So you want to, if you are a bookkeeper, there are resources where you can get more detailed information. If you are a business owner, I hope that this gives you a good foundation for you to get to know your business better, get to know your books better. And I really, really encourage you to do the entire series all the way down to the last Tuesday of the month. It's only 3 more. And, oh, no, that's where you're located. So, so you can get a rounded idea of what your bookkeeper should be doing, or you as a business owner and bookkeeper. And again, as a business owner, you might start getting too busy with your business for you to keep the books. Don't let it pile up year after year. Try to, if you realize that you're not able to keep your books, then get a bookkeeper, because it's going to affect, you are not going to know exactly what is happening with your business until all that information, all those bills, all those invoices, all those receipts are put into the right place, and then reports are generated for you, okay? So if basically knowledge is power, this is what I'm trying to instill in everyone. Know what you're doing so that you get accurate information, and then good decisions can be made on that. So I hope you're here next week. I hope you enjoyed today. And any comments, feel free to post them in the chat room. I will see those later, and I hope you have a good rest of the day. Mary Jo?
I want to thank you all for attending today's presentation. The presentations run from 10 a.m. to approximately 11:15 a.m. So if you can block out that time in your schedule to attend the whole session, that would be fabulous. And on behalf of our state director, Mr. Ted Gutierrez, I want to thank you all for attending, and we'll look forward to seeing you next week. Thank you very much and have a great day.